Good morning, good afternoon, good evening, everyone from anywhere in the world, and welcome to today's webinar on Mastering Ichimoku Strategies. My name is Ali Mortazavi, and I'm excited to guide you through the fascinating world of Ichimoku Kinko Hyo, a powerful tool that can enhance your trading decisions. This is our third session of the course on the Ichimoku Kinko Hyo, brought to you by Errante. Whether you are new to Ichimoku or looking to refine your skills, today's session will provide you with practical insights and strategies that you can apply to various markets. So, before we dive into the content, I want to make sure that everyone is comfortable and ready for an interactive session. So we'll cover a lot of ground today. So I encourage you to take notes and ask questions as we go along. There will be these designated times for Q&A at the end of the session, but feel free to jot down your questions or comments as they arise, and we'll address them as at the appropriate moment for sure. And as usual, before we begin, please note that the content of this webinar should not be construed as investment advice. The strategies and information provided are for educational purposes only and should not be considered as a recommendation to trade, because trading CFDs carries a high level of risk and it's possible to lose all your invested capital. Please ensure you understand the risks involved and seek independent advice if necessary. And by that, let's move on to our agenda for today. Let us start by taking a quick look at today's agenda to give you a sense of what to expect. First, introduction to Ichimoku Kinko Hyo. We will begin with a very brief overview of the Ichimoku Kinko Hyo indicator. It will be mostly a recap from our previous sessions. The segment will introduce you to the key components of Ichimoku, such as the Tenkan-sen, Kijun-sen, Kumo, and Chikou span. Understanding these elements is essential because they form the foundation of the strategies we'll be discussing later on. And then we will explore some of the most effective Ichimoku strategies, including the Kumo breakout strategy, Tenkan Kujin cross strategy, and Kumo twist strategy. Each of these strategies provides unique insights into market trends, momentum, and potential reversals. We will break down how to implement each strategy and discuss when and why they work. Then we will take a look, the multiple time frame analysis. Following that, we will discuss this concept. This approach is crucial for aligning your trades with the broader market trend while refining your entries and exits on shorter time frames. We will walk through how to use Ichimoku across different time frames to enhance the accuracy and timing of your trend, your trades. And then after we've covered the core strategies, we'll shift our focus to applying Ichimoku in different market conditions. Whether you're dealing with trending, ranging, or volatile markets, we'll discuss how to adopt your Ichimoku strategies to suit each scenario. This adaptability is one of Ichimoku's greatest strengths, and mastering it will make you a more versatile trader. And as always, you have a Q&A session, so you can participate in an interactive discussion and Q&A sessions to reinforce your unique trading style and solidify your knowledge. Here you go. Before we dive into specific strategies, it's important to build a solid foundation by understanding what Ichimoku Kinko Hyo is and how its various components work together. So let's start with the name Ichimoku Kinko Hyo. If you remember in Japanese, Ichimoku means one glance, Kinko translated to equilibrium, and Hyo means chart. So Ichimoku Kinko Hyo literally translates to one glance equilibrium chart, and this name is very telling because the indicator is designed to give you a quick yet comprehensive overview of the market's current state, trend direction, momentum, and potential uh, support and resistance levels, all in a single glance. Ichimoku consists of five key components, each contributing to the holistic view. These are first Tenkan-sen, as we know it as conversion line. This is the fastest moving line on the chart and is calculated as the average of the highest high and the lowest low over the last 9 periods or last 9 candles. The Tenkan-sen reflects short-term price momentum and is often used as a trigger line for potential entries or exits. Uh, then you have the Kijun-sen, which is a bit slower, calculated over the last 26 periods. It represents medium-term trend direction and serves as a crucial support or resistance level. When combined with the Tenkan-sen, it helps in identifying key crossovers that can signal trading opportunities. The other component is Senko span A. We know it as the leading span A. This is one of the two lines that form the Kumo or cloud. And Senko span A is the average of the Tenkan-sen and Kijun-sen projected 26 periods into the future. And this line marks one boundary of the Kumo and reacts more quickly to price changes. And then we have Senko span B, the second boundary of the Kumo, Senko span B, which we know it as the leading span B2, is the average of the highest high and lowest low over the past 52 periods, also projected 26 periods at. Because it considers a longer period is slower to react, but provides significant support and resistance level. The last but not least, these two together construct the Kumo uh, or the cloud, which is another, let's say, flexible or let's say dynamic support and resistance level. And then the last but not least is Chico span. We know it as the lagging line too. The Chico span is a closing price plotted 26 periods back on the chart. It acts as a confirmation tool, allowing you to see how current prices compare to past performance. This lagging line is crucial for confirming the strength of trends and potential reversals. Okay, how these components work together. Uh, At first glance, the Ichimoku chart might seem overwhelming with so many lines, but each of these components plays a specific role. The Tenkan-sen and Kijun-sen help in determining short to medium-term trend direction and potential entry points. The Kumo, formed by Senko span A and B, creates a dynamic area of support and resistance that adapts to price changes over time. The Chico span provides historical context, helping to confirm or refute signals generated by the other components. And one might ask, why Ichimoku? What makes Ichimoku so powerful? Uh, the matter of fact is its ability to provide multiple layers of information. You can define trend direction, trend strength, the trend's momentum, and also the reversal points all at once. Instead of relying on multiple separate indicators, Ichimoku gives you, let's say, a complete market picture in a single chart, reducing the need for cluttered screens and simplifying your analysis process. So in today's session, we are going to explore how you can use Ichimoku to make informed trading decisions. We'll cover specific strategies like the Kumo breakout, Tenkan Kijun cross, and Kumo twist. And we'll also look at how to apply these strategies across different markets, like different, let's say, the FX products. Okay, so let's move on to our first strategy. Now that we have familiarized ourselves with the components of the Ichimoku Kinko Hyo indicator, it's time to delve into one of the most essential strategies that this indicator offers, the Kumo breakout strategy. This strategy is particularly effective for identifying potential trend reversals and new trend formations, which are crucial for capturing significant market moves. Let's start by revisiting what the Kumo or cloud represents on the Ichimoku chart. The Kumo is formed by two lines, Senko span A and Senko span B. These lines are projected 26 periods into the future, creating a cloud that serves as a dynamic area of support and resistance. The Kumo is unique because it doesn't just represent a static support or resistance level. It adapts to market conditions. A thick Kumo indicates a stronger barrier to price movement, implying robust support or resistance. On the other hand, a thin Kumo suggests weaker barriers, making it easier for the price to break through. Understanding the thickness of the Kumo is crucial when considering breakouts, as it gives us insights into the potential strength of the breakout and the likelihood of leading to sustained trend. So let's discuss the identifying a Kumo breakout. A Kumo breakout occurs when the price decisively moves above or below the cloud. When we say decisively, we're looking for a clear, strong move that breaks through the Kumo without hesitation. And this is significant because the Kumo represents an equilibrium zone where buyers and sellers are relatively balanced. So a breakout indicates that one side, bulls or bears, has gained control, potentially leading to a new trend. So we can break it down to bullish and bearish breakdown. Let's see what is a bullish breakout. When the price breaks above the Kumo, it signals a potential shift towards an upward trend. This is often interpreted as a sign that bullish momentum is gaining strength. However, it's important to wait for confirmation before jumping into a trade. For instance, if the breakout is accompanied by the Tenkan-sen crossing above Kijun-sen, it reinforces the bullish sentiment and increases the likelihood of a sustained uptrend. On the other side, or conversely, a price break below the Kumo suggests the shift towards a downward trend, and this indicates the bearish momentum, which is starting to dominate. Similar to the bullish breakout, confirmation from other Ichimoku components such as a bearish such as a bearish Tenkan-sen Kijun cross or the Chikou span moving below the price can strengthen the signal and help validate the trend direction. So the confirmation and avoiding false signals is as important as the getting signal, okay? While a Kumo breakout is a strong indicator of a potential trend change, relying solely on this signal can lead to false breakouts, especially in volatile or range-bound markets. To enhance the reliability of your trades, it's essential to seek confirmation through other elements of the Ichimoku system. One of them can be, let's say, Chikou span confirmation. Before we get that through those we get through those elements, let's take a look at this screenshot that I have here to demonstrate this in a clear way. For example, here we have a bullish breakout when, let's say, the price breaks above the Kumo, signals a potential shift towards an upward trend, specifically when we have a bearish Kumo, which means the Senko span A is below the Senko span B, and this breakout occurs when the price breaks above both of those lines, specifically the Senko span B, and then crosses above the last market top here after this correction wave, and getting above the Kumo is with this very long candle is a very bullish signal for us, so we consider it as a bullish breakout. And then a bearish breakout, as we discussed, occurs when the price break below the Kumo, suggesting a shift towards a downward trend. This indicates that bearish momentum is starting to dominate. And similar to the bullish breakout, confirmation from other Ichimoku components is really essential. For example, here we see the two things usually happening. The Kumo twist is happening uh, with this shift in the market sentiment, and also we have the Tenkan Sen crossing above Kijun Sen uh, in the following candles. And also we have a similar pattern here. We have a very decisive uh, break through the Kumo, and then we have a Tenkan Sen moving below the Kijun Sen, both with negative slope below the Kumo, and which is a very great sign to confirm this bearish breakout here. So while the Kumo breakout is a strong indicator of a potential trend change, relying solely on this signal can lead to false breakouts, especially in volatile or range-bound markets. So the Chikou span or lagging line is a critical component of confirming the strength of a breakout. If the Chikou span is positioned above the price during a bullish breakout, like what we see here in this slide, or below the price during a bearish breakout, it confirms that the current price action aligns with the past trend, adding credibility to the breakout. Even with a strong confirmation, every trade carries a risk, which is why it's crucial to have a solid risk management plan in place. Here are some best practices for managing risk when trading Kumo breakouts. First, setting stop loss orders. One effective strategy is to place your stop loss order just inside the Kumo. This is what you can do, maybe below the Senko span B or A, the last Kumo boundary, which is broken. Okay, sometimes above it for a bearish breakout and below it for a bullish breakout. So this placement allows you to protect your trade from significant losses if the breakout fails and the price moves back into the cloud. Uh, Also, it's also important to consider the broader market environment when trading breakouts. Breakouts in trading and in trending markets tend to be more reliable as they often signify the continuation of a strong trend. However, in range-bound or choppy markets, breakouts are more prone to failure. So extra caution and additional confirmation are needed before entering a trade. And now that we've covered the Kumo breakout strategy, let's turn our attention to another key aspect of the Ichimoku Kinko Hyo system, the Tenkan Kijun cross strategy. This strategy focuses on the interaction between the Tenkan Sen and Kijun Sen, uh, which are crucial for understanding short to medium term market momentum. By mastering this strategy, you can identify timely entry and exit points in your trades, particularly in trending markets. So let's begin with to fully grasp the Tenkan and Kijun cross strategy. It's essential to understand the roles of the Tenkan-sen and Kijun-sen lines. We know Tenkan-sen or conversion line uh, is calculated by averaging the highest high and the lowest low over the past 9 periods or past 9 candlesticks. It's a fast-moving line that reflects short-term market sentiment and momentum. Because it's so responsive, the Tenkan-sen is often used as a trigger line for potential trading signals. And also the Kijun Sen, on the other hand, is calculated by averaging the highest high and lowest low over the past 26 periods or candlesticks. It represents the medium-term trend and serves as a more stable reference point. The Kijun Sen often acts as a dynamic support or resistance level, and its interaction with the Tenkan Sen is where this strategy shines. In this strategy, we focus on the points where the Tenkan-sen crosses the Kijun-sen, which can signal potential changes in market condition and market direction. First, a bullish cross. It occurs when the Tenkan-sen crosses above the Kijun-sen. This indicates that short-term momentum is gaining strength relative to the medium-term trend, suggesting a potential upward move. This type of cross is particularly significant when it occurs above the Kumo, as it indicates that the market is in a strong bullish phase, making it an opportune time to consider entering a long position. Conversely, we have a bearish cross. It happens when the Tenkan-sen crosses below the Kijun-sen. This suggests that short-term momentum is weakening relative to the medium-term trend, which could lead to a downward move. A bearish cross below the Kumo is a strong signal of a bearish trend, indicating a potential opportunity to enter a short position. Let's explore how to use this strategy in real-world trading. But before that, keep in mind that the signal's strength is enhanced when the crossover happens above the Kumo for bullish cross and below the Kumo for a bearish cross. For example, you see here we have the Euro USD chart and the let's go to maybe a 15, 30-minute chart. Yep. Let us start from here. This is the beginning stages of a new uptrend into market. We have the price Tenkan-sen, Kijun-sen, and Chikou span all below the Kumo, and also the Chikou span below the price. And here we have the consolidation phase, or let's say the range bound market below the Kumo, and then we have this rebound to the Kumo. We consider the Kumo a very strong resistance level right here, and then we have a crossover, the Tenkan Kijun crossover here to the upside, but below the Kumo, which gives us a very weak signal with the price moving above or crossing above the both of these slow and mid-term, short-term and mid-term, let's say key levels. Okay, but we are below the Kumo, so we consider it as a very weak signal. Along with the price, we have this pullback to the both Tenkan-sen and Kijun-sen here, and then we have the breakout above the last market top, this long, let's say shooting a star somehow, or a uh, long leg doji uh, here, and above the Kumo, breaking above the Kumo. So we have a Tenkan-sen, we have a Kumo breakout above the uh, last market top. So this is a very strong bullish signal for us. And in this scenario, we can put our stop loss maybe here, write it down somehow, at the last market bottom. And we can have this point as our entry. And then we can project a 1-to-1 risk reward ratio, maybe to the upside. And this could be somehow, or 1-to-2, let's say. As TP1 and TP2. So we'll be able to gain the momentum and write the whole, let's say, trend there. Another example that I can bring into your attention is here. This is a very nice case study. Okay, so let's get back to our slide to maybe explain it in more details. As you see here, we have two examples of the Tenkan Kijun crossover. So we call the bullish cross as a golden cross, and the bearish cross is a death cross. And here you see a bullish Tenkan-sen cross above the Kumo is a strong buy signal, especially if confirmed by the Chikou span above the price, being above the price. And this combination suggests that the market is aligned in a bullish direction across multiple time frames. Similarly, you see here a bearish cross below the Kumo is a strong sell signal indicating that the market is likely to continue moving down. The Tenkan Kijun cross can also be used to time exits. For example, if you are in a long position and the Tenkan-sen crosses below the Kijun-sen, it might be a signal to exit your trade as short-term momentum is turning bearish. Conversely, if you are in a short position and see a bullish cross, it could be time to close your trade to avoid potential losses for a market reversal. While the Tenkan Kijun cross is a powerful signal, it's important to confirm these signals with other elements of the Ichimoku system to increase their reliability. For example, a cross that occurs above the Kumo, as you see in this slide, is stronger and more reliable because it aligns with the overall trend direction indicated by the Kumo. This adds a layer of confirmation that the cross is not just a short-term fluctuation, but part of a broader trend. And also the position of the Chikou span relative to the price is another key confirmation tool. If the Chikou span is above the price in a bullish cross scenario, it confirms that the current price is above where it was 26 periods ago, reinforcing the bullish momentum. The opposite applies for bearish signals. Again, effective risk management is crucial when trading the Tenkan Kijun cross. Here are some strategies to manage risk. First, place a stop loss order at logical levels to protect against adverse market moves. And the best place is to find a last market bottom for bullish signal or last market top for bearish signals. And then you are able to put your stop loss with a buffer, maybe, for example, around these key levels. Or also you can choose the Kumo lines to put your stop loss. But I really prefer, I would suggest using the price indicators as the best key places to put your stop loss, because the price is the best indicator we have in the market. So it's better to rely on the market action and find the actual support and resistance levels which are represented in market tops and market bottoms, and adjust your trade size based on the strength of the signal and your risk tolerance. Stronger signals, such as a bullish cross above the Kumo confirmed by the Chico span, might justify a larger position size, or you can go with a whole position size you have calculated based on your risk limit. Conversely, weaker signals, or those without a strong confirmation, should be traded more cautiously with smaller position size. That's cool. So by focusing on these crossovers and confirming them with other Ichimoku components, you can improve your timing for entering and exiting trades, aligning yourself with the, let's say, prevailing market momentum. So here we have bullish cross, we have a bearish cross, and the Kumo support is key in this strategy. So at this moment, our entry will be at the first break above the last market top, and our stop loss will be at the last market bottom. Okay, so this is how we trade this setup. And here we put our stop loss at the last market top, and our entry point will be the first breakout point to the downside below the last market top as the most significant market support level. So as soon as we see this breakout, so we usually be able to open a sell position here. And next, we're going to explore a more advanced concept within the Ichimoku Kinko Hyo system, the Kumo twist strategy. This strategy is particularly valuable for traders looking to anticipate potential trend reversals or shifts in market sentiments before they become apparent in the price action. Understanding and utilizing the Kumo twist can give you an edge in recognizing early signs of market transitions. And let's start by understanding what exactly a Kumo twist is. As you know, the Kumo or cloud is formed by two lines, okay? Senko span A and Senko span B. The color of the Kumo changes depending on which of these lines is on top. When Senko span A is above Senko span B, the Kumo is typically shaded one color, often lighter, and here we have a blue one. Yep, in this slide you can see. Conversely, when Senko span B is above Senko span A, the Kumo is shaded another color, often red here. We have a bearish Kumo. A Kumo twist occurs when Senko span A crosses over Senko span B or vice versa, resulting in a change in the color of the clouds. Okay, so this twist indicates a shift in the balance of power between buyers and sellers and can be an early warning sign of a potential trend reversal or a weakening of the current trend, depends on the price action. For example, if you see the color of the Kumo is changing because of the twist between two boundary lines, and the price is making, for example, higher highs or lower lows. So in that case, You can add that as a confirmation to your trading strategy or to identify the market direction. But let's take it to some important points here. The Kumo twist is significant because it often precedes major trend changes. It doesn't guarantee an immediate reversal, but it does signal that the current trend may be losing strength or that the market is entering a period of consolidation before potentially reversing. For example, if a market has been in a downtrend, like here, and you see a Kumo twist from bearish to bullish, right? What happens here? It suggests that the sellers might be losing control and the buyers could start to gain momentum. Similarly, a bullish Kumo twist during an uptrend could indicate that the uptrend is weakening and a reversal might be on the horizon, as what we have seen here. This is a Euro USD H4. So the Kumo twist is often an early indicator, very important, meaning it can give you advance notice of a potential trend change. However, because it's an early signal, it's crucial to wait for additional confirmation before entering a trade. Acting solely on Kumo twist without confirmation can lead to false signals and premature trades. So we have the Kumo twist highlighting the point where Senko span A crosses Senko span B, and it indicates the potential for a trend changes. Again, the way we can trade this setup, given that the Kumo twist is an early signal, managing risk is particularly important when trading these strategies. Consider placing tighter stop loss when trading based on the Kumo twist, especially if the twist has not yet been confirmed by price action or other Ichimoku components. This helps to protect your capital in case the market doesn't follow through with the expected trend changes, because it's a very early signal. And another approach is to scale into your position as the new trend begins to establish itself. For example, you might enter a smaller position following a Kumo twist and add to it as more confirmation signals appear. Conversely, if you're already in a trade and see a Kumo twist that suggests a potential reversal, you might start scaling out of your position to lock in profits and reduce exposures to potential reversals. And always consider the overall market environment when interpreting a Kumo twist. For example, during periods of high volatility or in markets prone to sudden reversals, Kumo twists might occur more frequently and could lead to more false signals. In such cases, it's even more important to rely on confirmation from other indicators and to be cautious with your position sizing. And here, for example, you can see Cinco span A crosses above Cinco span B, changing the color of the Kumo from bearish to bullish. It's actually preceded by this long bullish candlestick here and a breaking above the last market bottom here. This is the last market bottom here. During this downtrend, this is a bullish signal for us, which is accompanied by crossing above the Tenkan-sen and Kijun-sen lines as well. And then we see it continues crossing above the Kumo as well. And at the same time, because it is the 26 periods forwarded, we can confirm the signal with other components firstly, and so we can plan to scale the trade For example, we can enter at the breaking above the last market bottom during this downtrend with a smaller size, and then we can add to the size above the Kumo at here at this point when we have all the components confirming the bullish trend. And we have to put our stop loss somewhere here at the previous market bottom, and then we can go to write a trend, a trend, or we can use a 1-to-1 or 1-to-2 reward to risk ratio. This example illustrates the importance of waiting for the price to confirm the Kumo twist before committing to a trade. By being patient and looking for additional confirmation, you can avoid jumping in too early and increase the likelihood of a successful trade. So you see here, we can just point out this Kumo twist here. This is another signal, the bearish signal. You see the after Tenkan Kijun dead cross, yes, we have the price crossing below the Tenkan Sen as the let's say our conversion line, and then breaking below the last market bottom, accompanied with breaking the Kumo to the downside. And at this candle we will be able to see the Kumo twist as well. So here we have the Chico span below the price, which means the price is below its 26 period lagging price. And this is another confirmation for us. So we can enter the market at this breakout point with a smaller size, and then we can add to our size after maybe we see this rebound to the Tenkan Sen, or we see a complete a closed candle below the Kumo, while we have a twisted Kumo to the bearish head. And this is the bullish signal of the, let's say, Kumo twist. And the last thing to discuss as we continue to build on the foundation of Ichimoku strategies, it's important to reduce it, to introduce a concept that can significantly enhance the accuracy of your trading decisions, which is multiple time frame analysis. This approach involves applying the Ichimoku indicator across different time frames to get a more comprehensive and nuanced different time frames to get a more let's say comprehensive and nuanced understanding of the market. By using multiple time frames, you can align your trades with the broader trend while timing your entries and exit more precisely in shorter time frames. Let us start with the reasoning behind multiple time frame analysis. Markets are often driven by trends that occur on different time frames. For example, a stock or currency pair might be in a strong uptrend on the weekly chart, but experiencing short-term corrections on the daily chart. Yes, I think you might agree with me. By analyzing multiple time frames, we can ensure that our trades are in harmony with the dominant trend, which increases the likelihood of success in the market. This technique also helps in filtering out noise that's common on shorter time frames. If you are trading on an hourly chart, for instance, you might encounter numerous minor fluctuations that don't reflect the overall market direction. By referring to a higher time frame, you can better distinguish between noise and genuine trend shifts. Now, let's explore how to apply Ichimoku across multiple time frames effectively. Let's start with a higher time frame, such as the daily or weekly chart, to establish the overall trend direction. This time frame provides you with a broader perspective and helps you identify whether the market is trending up, down, or sideways. For example, if the price is consistently above the Kumo on the daily chart, the market is likely in a strong uptrend. Then, once you have identified the dominant trend on the higher time frame, move to a lower time frame, such as the 4 hour or 1 hour chart to fine tune your entry and exit points. Here you can use Ichimoku signals like the Tenkan Kijun cross, Kumo breakouts, or even Kumo twists to time your trades with greater precision. And the one important thing is one of the key benefits of multiple time frame analysis is that it allows you to align signals across different time frames. For example, if you see a bullish Kumo breakout on the daily chart, you might wait for a bullish Tenkan Kijun cross on the H4 chart to confirm the entry. This alignment of signal across time frames add layers of confirmation to your trade and increases its probability of success. Let's walk through a practical example here to illustrate this concept. For example, here on the daily chart of the NZD USD, you can see that the price is consistently below the Kumo, and also you can see this bearish breakout or Kumo breakout on the daily chart. So this tells us that the overall market direction is bearish, and we should be looking for short opportunities rather than long opportunities. And then when we switch to the H4 charts, we notice a recent pullback where the price, you see here, touched the Kijun-sen and Tenkan-sen, and then declining toward this market bottom here. We notice this recent, let's say, rebound where the price touched the Kijun-sen but remained below the Kumo and below the both averages. And this could be an excellent selling opportunity for us when we see the breaking below the last market bottom here on the H4 time frame, which is confirmed by the daily time frame, or let's say is aligned with the overall bearish trend on a higher time frame. So in this scenario, by using the daily chart to confirm the overall trend and the H4 chart to pinpoint our entry, we are aligning our trend, our trade with the broader market direction while taking advantage of short-term price movements. This alignment minimizes the risk of entering a trade that goes against the prevailing trend, which is one of the most common pitfalls in trading. So there are several key benefits to use multiple time frame analysis with Ichimoku. There are several key benefits for sure. By starting with a higher time frame, you get a clear picture of the dominant trend, reducing the chances of trading against it. Also, the lower time frame allow you to fine-tune your entries and exits, optimizing your risk-reward ratio. For example, we can identify this Kumo breakout on the daily chart, and then we can shift on a lower time frame, aligning signals across multiple time frames, and then we can find this let's say breakout signal here and enter here and put our stop loss at the last market top, and then we will be able to pinpoint a very great entry to sell the market. And we can be confident that we are not against the overall or general market direction. While multiple time frame analysis can improve your trading accuracy, it also requires disciplined risk management. So consider adjusting your position size based on the strength of the signal and the time frame. Trades aligned with a strong trend on the higher time frame might justify a larger position size, while those based on shorter time frame signals should be approached more cautiously. Place your stop loss orders strategically based on both the higher and lower time frames. Usually, if you are going to trade on the lower time frame, which is the core concept of this strategy, you should put your stop loss on that chart and on the last market top or market bottom. So one of the risks of using multiple time frames, which we need to keep in mind, is the uh, temptation to overtrade by constantly shifting between time frames. I recommend stay focused on your primary trading plan and only act when the signals across your chosen time frames align clearly. So higher time frame, lower time frame, and trend alignment is a key concept of the multi-time frame analysis. Okay, let me check how much time we have. That's cool. I guess we can go through another concept, which is uh, as important as what we have discussed, Ichimoku in different market conditions. One of the greatest strengths of the Ichimoku Kinko Hyo system is its versatility across different market conditions. Whether the market is trending, ranging, or experiencing high volatility, Ichimoku provides valuable insights that can help you make informed trading decisions. In this section, we'll explore how to adapt Ichimoku strategies to various market environments, ensuring that you can effectively navigate different scenarios and maximize your trading opportunities. Let's begin with trending markets where Ichimoku truly excels. A trending market is characterized by a clear directional movement. As for example, you see here we have a clear uptrend and we have a clear downtrend here. A trending market is characterized by a clear directional movement, either upward or downward, where price consistently make higher highs and higher lows in an uptrend, as you see here, or lower highs and lower lows in a downtrend, like this downtrend you see here on my chart. Ichimoku is particularly effective at identifying and confirming trends. In an uptrend, you're typically see the price above the Kumo with uh, let's find a nice uptrend to discuss it in greater detail. Yeah, you see here on the Euro USD H4, we have a very beautiful uptrend here. So what we see, we typically see the price above the Kumo with the Tenkan-sen above the Kijun-sen and the Chikou span positioned above the price. This is the illustration of a beautiful, perfect uptrend. This alignment of Ichimoku components provides a clear signal that the market is in a strong uptrend. Similarly, in a downtrend, let's find one. For example, somewhere like this, okay? In a downtrend, the price would be below the Kumo, as you see here, the Tenkan-sen below the Kijun-sen, and the Chikou span below the price and all the other components. So this is the characteristics of a downtrend or Ichimoku components arrangement in a downtrend. In a trending market, you can use strategies like the Kumo breakout to enter trades in the direction of the trend. For example, if the price breaks above the Kumo and it's supported by a bullish Tenkan Kijun cross, it's a stronger signal to go long. On the other hand, in a downtrend, the break below the Kumo with a bearish Tenkan Kijun cross could indicate a good opportunity to short the market. This is what you can see here, an opportunity to short the market with a Tenkan Kijun cross below the Kumo that you can short the market. Okay, ranging markets or markets that are moving sideways within a defined range present a different challenge. In these conditions, the price oscillates between support and resistance levels without a clear directional trend. First, in a ranging market, the Ichimoku components may provide less clear direction. You might see the price moving back and forth through the Kumo with the Tenkan-sen and Kijun-sen crossing frequently, sometimes inside the Kumo. So the Chikou span might also be intervened with the price, indicating a lack of momentum compared to the price history. This is something like here. You see the price is hovering in the Kumo with the Tenkan-sen, Kijun-sen also in the Kumo and the Chikou span usually intervened with the price. In this scenario, you can use Ichimoku to identify, let's say, key support and resistance level within the range. The Kumo often acts as a dynamic support or resistance zone, so you can use the Senko span A and B as your boundaries for these ranges. For example, if the price is moving toward the lower boundary of the Kumo in a range, this area could serve as support, providing a potential buying opportunity. Conversely, if the price approaches the upper boundary of the Kumo, it might act as resistance, signaling a potential selling opportunity. Alternatively, you can wait for a breakout from the range. If the price breaks above or below the Kumo after a period of ranging, it could signal the start of a new trend. However, be cautious of false breakouts in ranging markets and always look for confirmation from other Ichimoku components or additional technical indicators, which the best of them is the price itself. However, we have another scenario type to discuss, which is the volatile markets, characterized by sharp and unpredictable price movements, can be more challenging to trade. However, Ichimoku can still provide valuable guidance in these conditions too. Adjusting setting for volatility. This is the first thing we need to take. In volatile markets, you might consider adjusting the setting of the Ichimoku indicator to respond more quickly to rapid price changes. For instance, shortening the period setting for the Tenkan-sen and Kijun-sen can help generate quicker signals that are more in tune with the fast-paced market environment. However, keep in mind that while this may help capture more opportunities, it could also result in more false signals because you fasten it a bit. So it's important to strike a balance. Another way is using Ichimoku for confirmation. In high volatility environments, it's crucial to rely on confirmation from multiple Ichimoku components. For example, if you see a Kumo twist or a Kumo breakout during a volatile market, look for additional confirmation from the Tenkan Kijun cross or the Chikou span. This layered confirmation can help you filter out false signals and focus on more reliable trading opportunities. Managing risk is even more important in volatile conditions. So consider using tighter stop losses and reducing your position size to account for the increased risk, but make sure that your stop loss is not less than the current ATR in the market. It should be at least 1.5 times the ATR or 2 times the ATR. It's a very, very important. Here you can see how the price consistently remains above the Kumo with the Tenkan-sen and Kijun-sen lines aligned bullishly. So this clear trend alignment offers multiple entry points. For example, by breaking above each market top, you can enter the market and capture this trend, or you can use these pullbacks as an opportunity to enter the market. And during this ranging market, in this example, the price moves within a well-defined range, which you can see is somehow in the boundary of the upper line and the lower line of this, let's say, Kumo. Yeah, the price is moving inside the Kumo. From here, you can just recognize it. Frequently crossing through the Kumo here, Ichimoku helps identify the key support and resistance levels where trades can be taken at the range boundaries. However, be prepared for a possibility of range breakout and use confirmation to validate any trade outside the range, because here you can see we have a breakout candle, but we don't have the confirmation candle because the following candle doesn't confirm the breakout candle because it's it's formed in a totally opposite color or opposite direction. And also they have the same story here. While we see, for example, after breaking above the Tenkan-sen and Kijun-sen, in the Kumo, we don't expect the price to move too far because we have the Senko span A as the strong resistance level waiting to encounter the price. So here is how we can use the Ichimoku components as support and resistance level. And also in the volatile market, which is a good, let's say here is a good example of that. We can use Ichimoku to filter signals in a volatile market. Notice how adjusting the Ichimoku setting and waiting for confirmation from multiple components can help navigate the erratic price movements more effectively. Okay, everyone, that's it from my side for now. I guess we almost covered all the content we planned. So I hope you found this webinar insightful for yourself, and I really encourage you to practice the Ichimoku Kinko Hyo trading strategies on demo account, and don't hesitate to get back to me with any question you might have. I would be more than happy to answer that. That's it from my side for now. Thank you so much for attending this webinar and for participating in our questions Q&A sessions. I hope to see you in our next webinars. Thank you so much. Have a great evening.